Assalamualaikum warahmatullahi wabarakatuh and good morning to Madam Nur Hafiza as FIN544 lecturer. Today we will present about capital structure. Before that, let me introduce myself. My name is BATRISYIA binti ANNUAR APPANDI and I will be presenting about introduction and function of capital structure and how determining optimal capital structure. As we can see from the slide, capital structure is referring to the specific combination of debt and equity that has been used by company to finance its own entire operation and growth. The decision on the debt-equity ratio of the company is referring to the capital structure decision. A company can change or reorganize its existing capital structure, and this process is called as capital restructuring. The increase or decrease of the percentage of debt to capital is done with the aim of maximizing the value of the company. This is because the focus of financial manager is to choose a capital structure that can maximize the value of the company so that shareholders' wealth can be maximized while the minimum cost of capital can be done. There is some important of capital structures that need to know. The first one is value of the firm can be increased. The second one is maximization of return. The next one is minimization of cost of capital. The last one is minimization financial risk. There are 6 ways to determine optimal capital structure. First of all is business risk. As we know, company risk includes financial risk and business risk. The more business grows, the more potential the business to expose to financial risk. The next is taxes. Changes in tax implication play a key role in determining asset financing by companies, whether using debt or equity. Financial flexibility. Internal and external factors will influence companies' choices between debt or equity. Financial managers are given the ability to make changes to a company's capital structure according to change in the environment. In management preference, we are looking at behavior and attitude of the owner of the company, whether aggressive or not, in order to respond towards their capital restructuring. It is because the management style influences the method of raising capital. Lastly, contractual obligation is the factor about the ability to pay off debt when a company restructures its capital. It is necessary to find out whether the company can afford to pay its debts if involved in debt financing which has high debt value and leverage. Therefore, companies are in a good position when they have high debt and leverage but they have a high ability to repay.
My name is AZWANI binti ABDUL WAHAB. Today, I will talk about the factors that affect capital structure. The first factor is size of business. Small businesses have to face great difficulty in raising long-term finance. If it is at all able to get long-term loan, it has to accept unreasonable conditions and has high rate of interest. Such restrictive conditions make the capital structure inflexible for small companies, and management cannot freely run the business. Therefore, small businesses rely on share capital and retained earnings to meet their requirements of long-term funds. Small companies have to bear greater cost of raising long-term funds as compared to large companies. Besides, issuing ordinary share every time to raise long-term funds may result in loss of control by existing shareholders. Large companies are able to raise their long-term loans at comparatively cheaper terms and can issue ordinary shares and preference shares to the public. Due to issuance of share of high amount, the cost of issue is low in comparison to small companies. The second factor is flotation costs. These costs are incurred at the time of issue of securities. These costs include commission, brokerage, stationery, and other expenses. Normally, the cost of debt is less than cost of issuing share. Therefore, the company can be attracted toward the loan funds. In case of retained earning, no such issue expenses need to be incurred. Flotation costs are also the expenses for raising funds for external sources. For example, a survey about these expenses show that to sell one share, the company has to issue at least 500 application forms. Underwriting commission is 2.5% for debentures and 5% for equity capital. Another important thing is that flotation costs as a percentage of funds will decline. Therefore, the company can save in terms of flotation costs if it raises funds through the large companies of securities. Considering all these expenses, retained earnings should be used for financial requirements because they are funds without flotation expenses. The third factor is flexibility. The managerial ability to make adjustments in the sources of finance at the time of change in needs of funds is called flexibility. Capital structure of a company is called flexible when it does not face any difficulty to change its capitalization or the sources of finance. Therefore, the management should take into account the future effects on the present capital structure. Whenever a company needs finance for profitable investment, it must be able to raise necessary funds without delay and at reasonable cost. If less funds are required, company must be in a position to redeem the debentures and preference share capital. For example, if funds are available at 50% rate of interest per annum, but the company has outstanding debt at 80% per annum, the company can save in terms of interest expenses if it can repay the old debt and replace it by the new debt. The nature of business of a firm is a decisive factor in the capital structure. If the firm operates in a perfect competitive market, there are chances of suffering loss. In such a case, the firm should use debt in a small portion so that in case of loss in a year, the burden of interest payment could not affect the business of firm adversely. The nature of an organization business directly influences its capital requirements. For example, manufacturing industry requires large investment in plant, machinery, warehouses, and others, while trading concerns need relatively lesser investment in such assets. These assets continue to generate income and profit over an extended period of time.
Assalamualaikum. My name is MASTURA binti MASULINI. I would to present about discuss of financial district. Financial district is a word used frequently in corporate finance to describe any circumstance in which a person's or a company financial state causes them to struggle to pay their bills, particularly creditor loans payments. Besides that, financial sufferings that lasts for a long time can lead to bankruptcy. When a situation of financial trouble arises, it must be addressed as soon as possible to avoid the situation's worsening. If financial problems are not addressed quickly, they often escalate to greater financial problems. For example, an individual or company in financial district may see their credit rating drop. It would cause leaders to charge them to highest interest rate, making it difficult for them to borrow additional money to help them manage a period of reduced income or revenue. Next, there are many factors that can contribute to financial distress. First, poor product quality. A company offers poor quality in its product or services and consumers start buying from competitors, eventually forcing a business to close its doors. Second, struggling to break evens indicate a business cannot sustain itself from internal funds and needs to raise capital externally. This raises the company's business risk and lowers its creditworthiness with lenders, suppliers, investors, and banks. Third, poor seller growth or decline indicate the market is not positively receiving a company's products or services based on its business model. 4. Unexpected expenses. Unexpected large expenses such as significant medical bills or a costly car repair are another regular sources of financial hardship. Outline of major causes of business failures. First, lack of good customer care. It is critical that you place a high focus on customer service A company that provides excellent customer service grows. Return customers are attracted by excellent customer service, while reference consumers are attracted by reference customers. Learn to express your gratitude to your customers. Always ask them questions regarding the goods and provide them a discount if they write a review for you. Either positive or negative reviews. Customer will only come when there is no other choice if you are not close to them and treat them like any other sellers. Many businesses have died as a result of poor customer service. Second, lack of focus. Too many trivial duties can quickly detract entrepreneurs. They are taking initiatives every day that their focus shifts. A successful business person or entrepreneur will never lose sight of what's vital and when they become engrossed in minor. Professionalism in duty that can and should be delegated. Delegation is a skill that entrepreneurs should deploy when doing rather than becomes an obsession. The short sickness is clear. That's all for me. Thank you.
My name is Zulaika binti Haroni, and I'm going to explain about the integration of tax effects and financial cost distress. I'll show you the illustration to make it easier. Please take a look at this graph, where the x-axis moves from 0 to D as the debt grows and the firm's value rises as a result of introspection. However, the debt begins to slant as the debt grows, indicating that there is a greater possibility of bankruptcy as the debt grows. That is why bankruptcy cost becomes important and offset the interest tax shield. As a result, the company's value has not increased significantly. D is optimal capital structure, when the firm's value is at its peak point in the highest price of the stock, and after D, the larger the debt is, the firm's value will continue to decline because of bankruptcy costs, and the company may suffer financial distress. We can see that as the present value of financial distress cost increases, present value of tax shield on debt also increases in response. Thus, we can understand how both are integrated with each other. What can we conclude from this static of theory? The company can employ debt until it reaches its optimum point because the interest tax shield can raise the firm's value. However, after reaching the optimal position, the value of the asset will fall due to the increased cost of bankruptcy.
Assalamualaikum, my name is INTAN LYSHA binti SULAIMAN. We represent about agency cost of equity. First thing first, do you know what is agency cost of equity? Agency cost of equity is a cost that occurs between management and shareholder. This situation happens when both sides have a different interest and opinion. From management perspective, they will make a bad decision that will increase cost incurred by the company. The increases cost has not contributed to shareholder, even they need to give and contribute more to company. Actually, the shareholder want to maximize their share of the company to make sure they gain profit. For example, agency cost of equity is when the management increase a bonuses or they book an expensive place for staff, but shareholder not agree because they need to pay for the cost and they don't get any benefit from that. There are three factors that cause agency cost of equity. Firstly, is shrinking, means its tendency when someone have to work hard but the pay that they receive is not worth. That make them to do less work because the worker think if they are owner of the company, they should work hard compared to work as employee. They maintain less ownership interest in company because it may get lower return. Owner will shrink if they issue equity compared to that. Second is perquisite. Perquisite is a benefit that should be to the best worker even though they only have a small percentage in company. Last factor is overinvestment. It happens when the manager do not have interest in making a best investment, but the shareholder invest too much because they have small ownership. Next, how to reduce the agency cost of equity is through free cash flow hypothesis that can increase dividend payout and debt reduction. Free cash flow is the one-off opportunity that manager can reduce the shareholder wasteful activities. When the dividend need to pay is increased and the debt also increase, it will reduce the ability to shareholder doing wasteful activities. Other than that, they can implement an incentive scheme that can give benefit and motivate staff to work best for the company. Managers will try to maximize the value of the company and reduce the risk of going bankruptcy. Some other ways is management and shareholder need to follow the budget planning to make sure they do not spend more or over. Company also need to limit the business expenses. For example, traveling best estimated on budget without spend more than limit.
Hi, Assalamualaikum. My name is LYANA binti ABDUL WAHAB. My metric number is 2020972467. I'm from group RBA 2423A. Now, I will explain to you about pecking order theory. What is pecking order theory? Pecking order theory is a theory that explains the finance hierarchy that a business might use to determine their source of funding or capital. It is also a type of economic theory that is connected to capital structure. According to this theory, managers choose financial sources in a hierarchical form, which leads to hierarchy for pecking order theory that I will explain later. As you can see here, this is the flow hierarchy for pecking order theory. Based on the hierarchy, the initial sources should come from internal funding, which refers to the sources that derive from the company's business operation, which means the money might come from either the profit of the company or the company return earnings. And then, if the company internal finance is insufficient, they might seek external financing, which means the company obtains finance from external resources. External refinance should begin with debt financing and then profit to equity financing. Furthermore, based on the hierarchy for the pecking order theory, as the sources of financing goes from internal finance to external finance of debt to external finance of equity, the risk is increasing, while the cost of finance also increase. In conclusion, pecking order theory shows the first priority to seek funding is from the internal financing. And then, if their own resources were not enough, the managers will have to look for money from external financing. They will issue loans in order to raise money. When it is no longer possible to issue more debt, the last thing to do is to issue more equity. That is all for the hierarchy of pecking order theory from me. Thank you.
Last but not least, I'm going to explain about the signaling hypothesis. When an economy agent takes action to convey a positive signal to another agent, it is referred to as a signal hypothesis. The signal can be utilized for a variety of purposes, the most important of which is to address the issue of information asymmetry amongst traders. For example, a corporation may spend money to market a new product, because substantial expenditures communicate to investors, stakeholders, and other parties that they are confident in their product. They have determined that this is the most cost-effective kind of publicity for promoting of goods, as others have indicated. A basic dividend policy, on the other hand, refers to the management's favorable assessment of the firm's position prospects stated to financial markets. The company that has bright prospects, they will prefer to use debt because they know they will get high profits, so it's better for them to pay fixed interest compared to share percentage of profit to the shareholder. Because if they use equity in the more profits they have, means the higher money that they have to pay to shareholders. While if they use debt, they only have to pay fixed interest. Yet, if the company has poor prospect, they will prefer to use equity because they do not have to pay fixed interest. When the company is in bad condition, fixed interest look expensive. Moreover, using equity, if they get lost, they don't need to pay the dividend.